Welcome, everyone, and thank you for joining this quarter's Corporate Cash Briefing webinar. 7 years running now, we are the largest and longest running cash briefing. And this time, I would like to note that we'd like to welcome our participants today. Folks are dialing in from 29 different countries to join us on the cash briefing. And I have to say, wow, these markets never disappoint. Each day seems to bring a new twist for us, and just in the last few days, we've got tariffs, we've got Brexit, we've got central banks doing things, lots of things to talk about today. In fact, just 3 hours ago, the British government issued a white paper detailing a number of the Brexit proposals that we'll talk about in just a few minutes. And that's just to name a couple of the topics that we'll be talking about today. I'm Tony Carfang. I'm a Managing Director of Treasury Strategies, a division of Novantas, Inc. And as most of you know, we consult with corporate treasurers and financial institutions on treasury, payments, and liquidity issues. I'm joined today by three esteemed panelists: Debbie Cunningham from Federated Investors, Michelle Price from the Association of Corporate Treasurers, and Greg Favilovich from Fitch Ratings. Today, we'll discuss changes in corporate cash levels as well as the key topical issues I just mentioned. As a quick aside, everyone who's registered for this session will, in a day or two, will receive a copy of the presentation and a link to the recording on our Treasury Strategies YouTube channel. We invite you to visit the channel at your leisure. There are a lot of great videos up there, and if you just go onto YouTube and search for Treasury Strategies, we'll be at the top of the list. Should you wish to ask any questions, you can do so in the question box at the bottom right-hand corner of your screen. We'll handle most of these questions offline when the webinar is done, unless we can work it into the conversation. And remember, both bankers and corporate treasurers on the line today, should you have any needs in the area of treasury, payments, or liquidity, just give Treasury Strategies and Novantas a call. So let's jump right into our analysis of the corporate cash levels. And as we can see this quarter, again, corporate cash continues to rise and rise at an accelerating rate. In the U.S., corporate cash hit $2.66 trillion and actually hit records in every jurisdiction except for the UK, where it just dipped down slightly. In the U.S., at 2.66 trillion, that's up 15% year over year. Kind of leads to the question: is this the result of repatriation? Has money come into the U.S. And this is an artificial or short-term blip? Our sense is that is not the case. If that were the case, we would see big drops in other jurisdictions, either in Asia or the Eurozone, in the UK, and we have not seen that at all. This is kind of a conundrum, and I'm sure a conundrum for policymakers, because as economies grow, you'd expect cash to be deployed and cash levels actually decline. We did a historical analysis and found that over the last couple of decades, corporate cash has risen from 3.6% of total corporate balance sheets to 5.9%. That is, corporations are holding much more cash as a percentage of their total balance sheets than ever before. And if you apply those numbers to the various jurisdictions here, like to the 2.66 trillion in the U.S., for example, we find that difference, the 2.3% of extra cash that companies are now holding versus a couple of decades ago, is $1 trillion. That's a huge buffer on the balance sheets. Now, if we look at this as part of the overall trend line, we see the cash is well above trend. In the last several quarters, in every jurisdiction, you see the cash line well above the trend line. So not only is cash increasing, but it's increasing at an accelerating rate. Now, here's a chart that regular listeners have not seen before, and we put this in to answer some questions about what is in the corporate cash number. We believe most central banks measure these in the same way. And the U.S. corporate cash number represents a compilation by the Federal Reserve of cash held by incorporated entities in the U.S., and that's the 2.66 trillion. They also compute a non-corporate cash number. This is not retail; these are businesses, and the non-corporate cash number would be small businesses, partnerships, and sole proprietorships, which collectively add another 1.5 trillion to the overall picture. So we wanted to throw that in to add a little more color. When we look at cash as an overall percentage of the gross domestic products of each jurisdiction, it remains very high. These numbers have not pulled back at all. As most of you will recall, they grew rapidly, particularly around the time of the financial crisis. And we see sort of cash as a percentage of GDP as a measure of the overall efficiency of an economy, an overall efficiency of how much extra cash does an economy require to support a given level of economic output. And if we go to the next slide, we can see this differently when we show cash as a percent of GDP. No, actually, we're plotting cash against actual GDP here, and we can see very, very strong trend lines. Except for Japan, we're seeing R squares of 0.96 and 0.97, which is almost perfect correlation. But again, across the board, these are above trend lines. So as the economies have grown, corporate cash not only has grown to keep pace, but has grown at an accelerating rate. Now, what's curious here, and again, if we just look at the top left quadrant, corporate cash, we see a slope there of 186 billion per $1 trillion of deposit. 168. That means that for every the regression line shows that for every $1 trillion increase in U.S. GDP, corporations are holding an extra $168 billion of cash on their balance sheet. Now, remember from the previous chart, we showed cash as a percent of U.S. GDP of only 13%, yet for every new dollar of GDP, almost 17% is going into cash. So, this is showing that there's something really fundamental going on here in terms of the proclivity of corporations to hold more cash. I'm not going to take you through all 4 quadrants here, but I do want to point out in the Eurozone, remember on the prior chart, we showed Eurozone cash as 23% of Eurozone GDP, yet this regression line is showing that for every new dollar or every new euro of Eurozone GDP, 43% of that is going into cash, which kind of indicates some significant inefficiency going on there. Interesting to explore. The final cash chart that we'd like to show is the Reserve Bank balances. And as you can see here, in all 4 jurisdictions, we have very different policies going on. In the U.S., there was tapering, and then it has kind of leveled off. We're going to talk about that. That's going to be one of our panelist questions here. The Eurozone has been increasing the level of bank reserves at the same time that the Fed has been decreasing. And again, you see different slopes at the Bank of England and at the Bank of Japan. It's our sense of Treasury strategies that these lead to economic results that are very confusing for corporate treasurers and banking and bankers, and that may in fact be one reason why companies are just holding more cash. When you see the 4 major central banks in the world, theoretically run by brilliant people, each looking at the world and coming up with a different result, that kind of says, well, wait a minute, maybe I ought to just hold some cash for a while. until we really see what's going on. So that's our review of corporate cash. Next, we'd like to continue a topic that we talked about last time in our deep dive, and that was the trends in earnings credit rates. Those are the rates that bankers credit their corporate clients as an offset against service charges. So in effect, it is a rate the banks, quote unquote, pay on idle balances as an offset against fees that corporations would otherwise have to pay. So you could look at those as a short-term interest rate. We have new numbers to add to the chart that we showed last time. As we can see, the earnings credit rates have increased at a very slow pace, even at a time when market interest rates, and here we're comparing the U.S. earnings credit rates against the 90-day T-bill. While those rates have tripled, the earnings credit rates are well below and have not even doubled. As you can see, the spreads have widened from 19 basis points in January of 2017 to 117 basis points today. Now, prime money funds are right now hovering around 2%. So it's fascinating that corporate treasurers would keep cash in their banks at 59 basis points, and we'll talk about negotiation around that level in just a bit. It probably indicates that companies either have some inertia and haven't moved that last bit of cash on their balance sheets. Some recent research by Novantas shows that about $1 trillion in the U.S. is on deposit and earning these earnings credits. So we're not talking about nickels and dimes here. We're talking about companies with tens or hundreds of millions of dollars on deposit getting these 59 basis point rates in a market where like prime money market funds are around 2%. We're going to take you through a little bit of detail around this. We have several bullets on this next chart. The key highlights are that, well, yes, earnings credit rates have increased, but we've actually seen an interesting trend. Earnings credit rates on lower balance accounts have gone up faster than earnings credit rates on higher balance accounts. Now, that probably indicates that in 2017, banks actually were negotiating with specific customers for high balance earnings credit rates, and that has diminished, and so the rest of the bank customer base is catching up. We're also seeing a very wide range in those earnings credit rates. You'll all be getting a copy of the deck, so you can actually plow through the rest of these bullet points on your own. On this next chart, we're showing the actual results of Treasury Strategies clients. These are clients who use our in-depth service. In-depth is a software tool that helps companies manage their balances and their bank service charges and benchmark them against the marketplace. And we took a snippet out of our second quarter report, so this is right up to date information. And what you can see here, the red line represents the median across our customer base. And if we were to look at the $10 million deposit level, so a typical company at the median with $10 million on deposit in a bank account at the beginning of the second quarter was earning an earnings credit rate of 43 basis points. And again, this is a market that at that time was 1.9 to 2%. The blue lines represent the 25th and 75th percentiles, and so what this diagram shows is the range. So 50% of all of the samples in our in-depth database fall between those two blue lines. 25% of our customers are getting earnings credit rates above the top blue line, 25% below the bottom blue line, and 50% in the middle. And we can see the range. So 50, the middle 50% of our customers are receiving between 30 and 65 basis points on their earnings credit rate eligible bank balances. This also shows how rates scale based on the balance levels, and that may indicate that banks have different earnings credit rates that they're applying to different segments, or that they have negotiated one-off earnings credit rates with specific customers for specific balances. Just to show you how this has changed, I find this chart kind of interesting. The blue line represents the fourth quarter of 2017, and you can see how very low the earnings credit rates were. At on a $1 million deposit level in the fourth quarter of 17, a typical earnings credit rate was 20 basis points. That moved up to 35 basis points in the second quarter of 2018. So what we see is banks seem to have raised rates on the lower deposit levels, but if you see on the right-hand side at $100 million up to $1 billion in deposits, that hasn't moved very much. So all of you corporate treasurers out there, I think the loud and clear message is, collectively, you're sitting on $1 trillion that is earning well below market rates. You may have, there may be a lot of reasons for that. You may not have the technology in place to capture all of your balances every day and get them invested. You may not have visibility on all of your bank accounts, but these are all things that you really ought to be paying attention to, particularly with the gap to market so wide. We did a little analysis. We took the 4 largest U.S. banks against everybody else in our database. And on this particular chart, it's kind of fascinating. The blue line represent the largest 4 U.S. banks, and the red line represents all the other banks in our in-depth database. And there's an interesting split here at about the $7 or $8 million deposit level, and it seems like the largest banks are actually paying higher rates on low balance accounts than regional banks are, yet the regional banks are paying higher rates on larger balance accounts. It's interesting. It kind of makes sense if you think about it. Regional banks may have to bid up to get larger deposits, particularly since larger deposits would be uninsured deposits. But this is a number that we're increasingly going to keep an eye on for you. And then finally, we'd like to make a point that earnings credit rates seem to vary quite a bit by industry. And as you can see here, healthcare and higher ed organizations, for example, seem to be getting relatively lower earnings credit rates than real estate and insurance. And again, these are samples of customers coming out of our in-depth tools database. It's interesting here. You can see some fairly narrow ranges of earnings credit rates, although the insurance numbers seem to be fairly wide. Again, the point here is that you really need to be paying attention to these. There is variability. There looks like some negotiability here. As corporate treasurers, you need to work with your bankers to figure out how to get visibility on all of your balances so that you can deploy them more effectively into the capital markets and begin achieving market rates. So that's our little background on earnings credit rates. Now I'd like to move into our panel discussion and invite back in. We have Debbie Cunningham, Chief Investment Officer of Federated Investors, Greg Pavilovich, Senior Director at Fitch Ratings, and Michelle Price, the Associate Policy and Technical Director at the Association of Corporate Treasurers. Team, welcome. Thank you for joining us again. And we have a lot to talk about, so let's just jump right in. And the first thing we'd like to talk about with each of you is your outlook for interest rates. There have been rate hikes in the U.S., although the central banks in Europe don't seem to have been moving their rates forward at all. So let's start with Debbie Cunningham, Chief Investment Officer at Federated. Debbie, what's your outlook for the rest of 2018, and what are you looking at into 19?
Sure, Tony, thanks. We're really looking to be in agreement for the most part with the Fed dot plot at this point, which is a little bit scary because generally speaking, we've not been in total agreement with them. So for the remainder of 2018, we're looking for 2 additional rate hikes of 25 basis points each, one in the third quarter, one in the fourth quarter. And then moving into 2019, another 2 to possibly 3 rate hikes. And again, all this being data dependent. Right now, you know, we continue to see strong consumer. Obviously, the employment situation is working well. You know, we just had great ISM numbers from both a manufacturing as well as a non-manufacturing perspective for June, you know, confirming the strength in the manufacturing and non-manufacturing sectors. The housing market, despite you know, interest rates going higher, has not rolled over and died. Autos continue to be pretty strong, and overall inflation is within the tolerance ranges, as the Fed has mentioned to us at several points. You know, allowing it to go both below as well as above what their targets would be. But we continue to monitor that because it is definitely ticking upward. Both, you know, and with various regard to the measures, not just 1 or 2 measures, but basically all of them are moving above that 2% range at this point. So 2 more rate increases, 25 basis points, you know, that'll take us to what would be, you know, the 2.25 type of range as the bottom end, and that's, you know, probably to a point, maybe 2.5, 2 3/4. You know, early in 2019, where you get to a point where you're no longer normalizing from a Fed terminology perspective, but at that point, really starting a tightening process.
Interesting. So, and the tightening process would then alter your forecast for economic growth. Then, so at that point, the Fed would actually be slowing the U.S. economy.
In our minds, we think that starts to happen in early 2019.
So at about 2.5% interest rates, we see is your forecast of when we'd see tightening. Okay, Michelle, sitting over in London, I'd be interested in your sense here, or what you're hearing from corporate treasurers in the UK. Or around the world,
Sure.
Actually. You guys service the whole world.
Thanks, Tony. So the Bank of England's Monetary Policy Committee met in late June, and they decided to maintain bank rates at 0.5%. The market's now predicting that the Bank of England will raise its bank rate to 0.75% later this year. They actually were expecting an interest rate rise earlier in May, but that was really put off, as the Bank of England explained, because of weak economic data and falling inflation. And from a European perspective, the European Central Bank, in June, they announced an upcoming end to their massive QE program. And basically, we see this as the beginning of the end for monetary stimulus in the Eurozone. The ECB has stated that it expects to it expects rates to remain at the current level until summer 2019, and the current level is, you know, their deposit facilities are in negative at negative 40 basis points, and their main financing operations is flat at 0%. So that's that from the UK and Europe.
Interesting. And at negative interest rates, that's going to wreak havoc, I believe, for some of the new European money fund regulations that are about to kick in. But we'll hold that thought for just a minute.
Yep.
Greg from Fitch Ratings, what's your team's sense of what the rate outlook is?
Yeah, I think we're in line in the U.S. Fitch is forecasting GDP at 2.8% growth this year, 2.6 next year, and so just like Debbie, 2 more hikes this year. Fitch is at 3 rate hikes in 2019. Like you said in the like Michelle said, in the Eurozone, we're looking for the end of the current policy and beginning of tightening, and looking for policy rate to be at 0.25% in 2019, which, like you said, could be important, an important kind of point for European money fund reform for Euro LVNAV funds.
Right, right. Okay, one last question on the topic I'd like to shoot over to Debbie. What do you see, what's your prognosis for intermediate and longer term rates? Does the yield curve invert as we get into tightening?
Well, I think, up until probably the probably the second quarter of next year, it continues to flatten. I mean, depending upon then, what the economic activity is like, the potential for an inversion, I think is real in the second half of next year. We're not forecasting that. That's just a potential. Our own thought process at this point is that you start to see, you continue to see more of a flattening, not even just 2s to 10s, but when you're looking at, money market curves added in there, so overnights to 10s. And that process will continue without really having an inversion, at least not in the very close proximity, close future.
Great, thank you. Okay, I'd like to shift gears now to a topic that, just for those of you on the line, our team discussed over the last week, but continues to change day by day. And just within the last couple hours, the British government released a white paper that folks are still trying to plow through regarding Brexit and some more details. Fortunately, Michelle's been able to get her hands on this and begin looking through it. Michelle, tell us a little bit about Brexit.
Well, as you say, things change rather rapidly, and now the UK government appears to be heading towards a softer Brexit. I won't say a soft Brexit entirely, but a softer Brexit. And really, what does that mean? Well, it's a common rule book that will match EU standards on foods and goods. And therefore, the UK is going to be effectively subject to EU rules on food and goods. But what's interesting is services, which includes financial services, are a little bit different. And this white paper that's been published today, what it does, it sets out a framework for the cooperation for financial services. And it's cooperation, not equivalence of rules. And this really means the UK and the EU will not have current levels of access to each other's financial markets that they currently have. So I guess doing business between UK and EU in terms of banking is not going to be as easy going forward.
That's an important distinction. So with cooperation, as opposed to specific standards, it kind of means like the systems won't have standards to talk to each other. And I use that term loosely, but
yeah. So equivalence is really adopting their rules, and then you can trade freely because things are seen as equivalent, and that's not necessarily going to be the case for financial services.
So,
I don't know the detail yet, because I actually haven't been through the full white paper.
Well, we appreciate what you have been able to share and the insights you've developed. Now, we talked earlier last week about how treasurers of multinational companies are impacted by the uncertainty around Brexit. Could you share with us what you're hearing from some of the ACT members around the world about how Brexit is impacting the way they're actually managing their treasury operations?
Sure. So many of the UK corporates, the way we see it and what they're telling us is that they're still effectively in wait-and-see mode because of the uncertainty of what's coming out from the government decisions. they're still trying to understand how Brexit is going to impact the wider strategy of their company, and then secondly, as you know, what's coming out of this white paper, really understanding how Brexit is going to impact their banks and the products and services that their banks have been providing to them, you know, cash management, funding, derivatives, etc. So corporates are sort of saying that, you know, that they haven't done a lot of preparation for Brexit. We're hearing that the banks we know that the banks were told by their regulator, the FCA, that they needed to prepare for a worst case scenario, which is hard Brexit. But many of the banks, while they have got the plans on paper, they haven't necessarily implemented them. But at some time, you know, time is going to run out and they'll need to implement them or begin implementing them. I mean, we are beginning to hear of jobs moving and relocating, particularly in financial services, to Ireland, Germany, and other countries. So yeah, that's how things have moved on over the last quarter.
Interesting. Greg, from Fitch rating standpoint, and we know you're really active in the UK and Europe as well as the US. What are you guys thinking about the current uncertainty?
Yeah, I think there's two perspectives I can bring. One is around the impact on asset managers and money funds, and I'm sure Debbie can talk about that as well. And then the other one is to the extent you know, Fitch rates some of the corporates in Europe. What's the impact in terms of the relationship with Fitch's analysts? So maybe addressing that first. The regulations require, from ratings perspective, that ratings assigned on European continental corporates, we have actually analysts on the continent covering those. So there's going to be some shift of resources, let's say from the UK in London, where our primary office in Europe is, to other areas like Frankfurt and Spain perhaps, and France. But I think, you know, in terms of the experience for the rated corporates or entities, it's probably not going to be very impactful. The other perspective I mentioned, the impact on asset managers, I think our perspective is actually still unclear, and kind of the main issues are the extent that asset managers need the boots on the ground in Europe to satisfy their registration and presence requirements post-Brexit. There's a question of delegation. It seems like delegating investment management to a non-EU entity might work. And then in terms of funds, either European funds being sold into the UK or the other way around, my understanding is so far there are no limits announced on European funds being sold into the UK, and most money funds onshore in Europe are Luxembourg or Ireland domiciled. On the other hand, passporting of UK funds into the EU might be a different story. So there's certainly still some reshuffling of domiciles and kind of resources in the asset management industry.
It sounds like there could be some fairly material disruption there.
Obviously, I think everybody's gonna work as much as they can to make sure that the disruption to clients is going to be minimal. But I think it definitely is going to be a lot of work for us on the rating side, and for the asset managers on setting up their funds. You know, I think in a way similar to what we've seen with your U.S. reform and European money fund reform. You know, there's a lot of work that happens in the background, a lot of resources devoted to these things.
Well, Debbie, you're in the markets every day, moving billions of whatever currency. How do you see this? How's this impacting you currently, and how do you see this playing out?
Well, as Greg mentioned, it's interesting. We have, at least from our own shop's perspective, our dollar-denominated products in the EU space are domiciled in Ireland. We do not have euro denominated. We did, those were also Irish, but we closed them once we got into the negative interest rate environment. So we're dodging that bullet from a regulatory perspective. But because they're domiciled in Ireland and sold pretty much everywhere but Ireland, those ones really shouldn't be much of a problem. There's not much of a market for those funds in the UK already. Our sterling denominated funds, on the other hand, are very much UK centric, but they're also registered in the UK. So I actually don't think it's going to pose too much of a problem, no matter whether it's a hard Brexit, soft Brexit, one that allows for, the rules to be harmonized or segregated. I think at least for us, we're in a pretty good position with our products and our clients kind of aligning that, as Greg mentioned, we're working very hard for it not to become problematic.
Great. Thank you. Thank you. I have a question. I'm going to direct this at Debbie. Regarding central bank balance sheets, we've been talking for many cash briefings about the potential for central banks unwinding their balance sheets and getting their balance sheets back down to the levels they were before they were rapidly inflated following the financial crisis. And we saw the chart earlier today on the run up in bank reserves, and while they're down a little bit in the U.S., they're still at record highs around the rest of the world. Debbie, I've seen some things lately that indicate that, at least within the U.S., the Fed may be thinking about not unwinding its balance sheet any further and actually operating its business in the U.S. economy on a $4 trillion balance sheet rather than a $1 trillion balance sheet. That is massive. Is that just a rumor, or is there some truth to that?
Well, I think there is speculation about that, Tony. I don't know that there's truth or falsehood to it, but certainly there's speculation, and the speculation comes from a couple things. Number one, the Fed did give us a plan for 2018, the end of 2017 and 2018, for the downsizing of their balance sheet. So we're up to $40 billion per month this quarter. Total of $120 billion by the end of September. Then we move up to $50 billion per month in the fourth quarter, $150 billion at that point. They haven't given us a plan beyond that. And I think, that's where the questions lie. I think when they originally announced this way back in 2017, everybody thought maybe by mid-year of 2018, they'd have a plan for 2019. What draws that into question, where the speculation comes about now, is the behavior in the market, if you will, of where the Fed funds rate, the effective rate, and where where repo has been trading. So prior to the Fed increasing doing the last increase of the Fed funds target range in June, when it was at 1.5 to 175, repo was not trading down around the 1.5 level. Instead, it was trading up 172, 173 for at least the whole second half of the second quarter, much closer to IOER, the top end of the range, than to the RRP rate, which is the bottom end of the range. So when they made their increase, when they increased rates in June, they increased the target range by 25 basis points. It's now 175 to 2%. But rather than making the top end bounded by IOER at 2%, they reduced IOER instead by 5 basis points and made it a 195. And the reason for that is they felt like by keeping that range at a 195, that level at a 195, it would entice there would be less of a propensity for that overnight Fed funds effective and therefore repo rates to trade, other than at month ends and quarter ends, above that rate. And the reason that's a problem if it does trade above that rate. So let's say all of a sudden repo starts regularly trading at a 205 when the top end of the range that the Fed's trying to keep is 2%. The way that the Fed would have historically countered that is to add reserves to the system. However, adding reserves at a point in time when they're draining reserves, i.e. reducing the balance sheet, is conflicting with themselves. So, you know, that's where the thought process comes in. That is, you know, sort of the debate that's erupted since, you know, June, you know, over the last 3 weeks or so about what the Fed, in fact, may intend to do. You know, I think nobody thought they were ever going to go back down to a $1 trillion balance sheet, but I think people were thinking 2 to 3 trillion would be the likely, you know, sort of equilibrium level. I think probably there's some consideration that maybe 3 to 4 is the right level at this point, but certainly no confirmation of that, and it's all debate and discussion at this point.
It's fascinating. I'll refrain from editorializing, but you guys can check our website for some of our comments on the whole issue of the Fed paying interest on bank reserves going back to 2009 when that first started. Let's switch gears. European money fund regulations are about to kick in, and let's go to Michelle, since you've got the front row seat there. What do our listeners need to know about the new European regs?
Okay, so the European money market fund regulations, they come into play for new funds imminently in the next week or two, but for already existing funds, not until the 21st of January 2019. But we're really expecting to see implementation by corporates over Q3, Q4 of this year. What we're expecting is GBP-denominated, sterling-denominated funds will move to low volatility net asset value funds, while we're hearing that euro-denominated funds will primarily move to VNAV funds. And this difference is being caused by these negative interest rates in Euroland, where money market funds denominated in euros, they may not be able to operate as low volatility net asset value funds because the EU regulators are opposing this reverse distribution mechanism, which is, you know, basically the ability to cancel shares. Right. So, and you know, as you know, euro-denominated money market funds are in negative yield at the moment.
Well, that illustrates a little bit of a conundrum there. Now, Greg, you guys are in the business of rating these funds. How's this playing out on your radar?
Yeah, totally agree with Michelle's points. And you know, an interesting thing to think about is that when money fund reform in the U.S. Was happening, it coincided with the Fed starting to really raise rates, and I think that was helpful for the reform because government money funds here started picking up yields and made for, I guess, an easier transition for investors. And it's kind of curious that the same kind of convergence might happen in Europe as well with the euro funds as the European Central Bank is starting to tighten and rates potentially will rise. I think the convergence won't happen quite as well in terms of you know, rates being high enough for LVNAV funds right away. I think we're forecasting just a quarter of a percent rate in 2019. So that might not be enough to bring LVNAV funds into positive territory, but I guess we'll see. So again, we agree with those points, and we think that a lot of the transitions are going to happen in the fourth quarter. We know at least one fund manager publicly has said they're going to convert some of their funds into LVNAV at the end of November. So investors will be able to see how that's already working out. Another interesting point, again, and Tony, you're probably you've worked on this a lot in the U.S. with reform here, is investment policies for investors. So to the extent your policies are not clear or maybe don't allow a fund that's not stable NAV, that might be a challenge, and investors, at least it's worth for investors to take a look at their investment policies and see if they're able to invest in some of these products. But we've, as you said, we've been very active in the space, and I have to kind of give a nod to my colleague Alistair Sewell and his team. We've done a lot of papers and webinars around reform, and there are a lot of resources available on our website, kind of describing the features and how we think things are going to go. So if anybody's interested, kind of let me know. I'm happy to connect you with Alistair.
Great, and thanks for the plug. We have a very nice white paper on adjusting investment policies that Greg referenced, and just drop us an email and we'll be happy to send you that. Debbie, the new regs, I mean, they impact Federated from top to bottom. How do you see those playing out?
Since we don't have the split of retail and institutional in the Euro markets that we did in the U.S., really it's for the most part an institutional market. It's our thought, and gates and fees apply to all. It's our thought that, and certainly this is the feedback we're getting from our customers, that they're pretty comfortable staying their course. So if they're in a stable value prime product, they'll transition easily into the LVNAV prime product. If they're in a VNAV, they'll stay in the VNAV, and if they're in a stable value government product, they'll transition nicely to the stable value public debt product. So we're not seeing it to be hugely impactful at this point.
Good, thank you. Debbie, do you want to say? I'm sorry. Go ahead, Greg.
You mind if I just add one more point? I think it's actually very important to emphasize that the issue with the LVNAV really only impacts euro-denominated funds, given where interest rates are. So LVNAV is a viable option, I think, for pound and U.S. dollar funds. Yep.
Good. Let's turn to our last topic for just a second here. Michelle, can you give us an update on LIBOR, or lack thereof?
The transition away from LIBOR. But just from a UK perspective, just as a reminder, SONIA is the preferred risk-free rate that the UK financial regulators have chosen for those currently using GBP LIBOR to transition to. The ACT sits on the UK's risk-free rate working group, and we've also got various corporates who participate on topic-specific working groups, and those are meeting on a regular basis. Early in June, the ACT attended the Financial Stability Board official sector steering group, the SFB OWSG is what people refer to it as. And this is really central bankers from around the globe, including, representatives from the Fed. And that was held here in London, and a number of other trade associations attended as well. And together with them, we were able to present the key issues for the real economy that arise from this benchmark reform. And just to summarise those key issues in a sentence each, really the first one is coordination or lack thereof amongst the national working groups. And there are different risk-free rate working groups across the different currency jurisdictions. The second issue really is transparency and communication, and this is really trying to raise awareness amongst corporates and other market participants that there is going to be a move away from LIBOR. As soon as you move down into the small corporates, they're not even aware of this issue yet. The third issue really is the approach to the development of term rates. Now, that's a particular issue here in the UK because SONIA is currently only an overnight rate, and there's a wide variation in the work being conducted between the jurisdictions. The timing of the transition to the risk-free rates in each LIBOR currency really needs to be coordinated between the national working groups. Another issue that was raised is the treatment of legacy deals, because there are currently different approaches between the jurisdictions, and there needs to be some consensus on that, on not only legacy ones but also new deals. And last but not least, the key issue was the development of wording for documentation, and this needs to be coordinated. And really this is to avoid confusion in a lot of multi-currency transactions, such as cross-currency swaps. So I think the various national Treasury associations, you know, the NACT, the ACT, the European Association of Corporate Treasurers, they are starting to work together to really ensure that the concerns of the corporate are raised. A survey was undertaken by ISDA, and this was published late June, and this was really setting out the state of play. On the ACT, we do have a dedicated web page on useful guidance for corporates on these issues, and a lot of the issues that are there, you know, they're international issues. And there's a consultation coming out by ISDA, and that's, I think that comes out imminently in the next week or two. So that's something that all corporates should watch out for and respond to. I think that's it for the moment.
Well, thanks, and Michelle, and let me say, you know, corporate treasurers on the line here, you ought to keep your eye out for that ISDA consultation and make your opinions heard here. You know, we're basically changing a global reference rate, and that's going to impact flows in the money markets globally, the rates you pay, the spreads that you experience. Let me ask Debbie and Greg, any final comments on LIBOR before we wrap today?
Not for me.
You know, I think, you know, we in the U.S. very much as Michelle described, you know, we continue to work with the various constituents, you know, in building out a term curve, and then, you know, building in something that takes it from what would be the risk-free term curve to something that incorporates credit associated with it.
That's very important. Thank you. Well, I'd like to thank our panelists today. What a great set of comments on an important set of topics here. Debbie Cunningham, Chief Investment Officer of Federated Investors, Greg Favilovich, Senior Director at Fitch Ratings, and Michelle Price, the Associate Policy and Technical Director at the Association of Corporate Treasurers. And we'd like to thank all of you for attending the webinar. Again, participants from 29 countries today. That's really pretty cool. Remember, both bankers and corporate treasurers, should you have any needs in the area of treasury payments or liquidity, you know, give us a call at Treasury Strategies, or Debbie at Federated, Greg at Fitch, or Michelle at the ACT. Within a few days, you will all be receiving a copy of the deck that we used today, as well as a link to the recording. And we hope to see you all again on Thursday, October 11th for the third quarter quarterly cash briefing. Thank you all very much, and have a great quarter.